Welcome to the Broken Pie Chart Podcast, episode number 23. I'm your host, Derek Moore, and today we have a special guest, Jay Pestrichelli, back on the program, founder of Zega Financial and acclaimed author, I guess, right, Jay? How are you?
I'm doing great, Derek. Thanks for having me back.
Of course. Well, we may wind up doing a part two of this because we're a little bit pressed for time, but we're going to get into a couple things. And, you know, Jay, I thought this was a good idea. You and I always talk about sort of correlations and the idea of hedging versus doing things with bonds and the 60-40 portfolio. And, one of the things I kind of look at is the idea of a 60% stocks, 40% bonds. Is that a myth? I mean, it's this idea that over many, many years, people say, well, you can't do anything better than a 60-40. We think being long equities and being 100% in equities, but having a hedge is a better, approach to it. But I don't know, Jace.
My comment on that is kind of the widely accepted modern portfolio theory approach to long-term investing. And while the name implies that it's modern, it's really not. It was developed in the 1950s. It's 70 years ago. The market is a very different place now than it was when that concept was evaluated and tested and did prove to have some merit, but the world is a different place today, right? There's no reason to invest like your grandfather.
No, and I mean, I think also what people sometimes misunderstand about results. And so, I've talked about this recently, and this idea between you have a nominal return, which is just, hey, what did you get in a return? And if you add up all the returns and you divide by the number of instances, that's your average annual return. What somebody actually realizes is their compounded return, and we can talk about that. But then this is also this thing about, if you earn, let's say, 5%, and I'm going to go after bonds just a little bit, Jay, but if you earn 5% in bonds, but inflation was 4%, you really, after inflation, the back of the napkin is +1. It's actually less. And so, one of the things I did is I looked at 1928 to 2018. I looked at the 60s to 2018. And one of the things you realize is the real return annualized on the 10-year bond, and that's the total return, is about 2%. And so one of the challenges, I think, Jay, with holding bonds on 40% of your portfolio is what are you really getting on a real basis?
Yeah, maybe, Derek, it's worth just digging in a little bit what you mean about, real returns. Maybe it might be helpful to give an example that everybody could apply, right? So to their everyday life. And, we've always talked about the cost of a loaf of bread, today versus 30 years ago. But I think it's more important to compare, say, salaries or the cost of a home. When you look at what a home cost in, the 60s and the 70s, compare it to today, it's almost ridiculous. Right? Hey, you can't buy a house for $40,000 now, but guess what? You could back then. That kind of it's that kind of impact we're talking about when you look at the real return and what inflation can do to values over time. Do you have any color you want to add to that?
Yeah, I mean, and I think it's, I'm doing this from memory, but, I did something, if you made $100,000 in 2018, I think that was the equivalent to earning about $19,000 or $20,000 in 1976. And so it's the same, meaning your $20,000 was essentially like having $100,000 today in purchasing power. And so, and that's, Jay, as you know, with clients and with advisors working with clients. And if you're not keeping up with inflation, you're losing purchasing power. I mean, all the stuff that you need to buy, especially in retirement, is getting more expensive. And so real returns really matter.
Yeah, I mean, I can't tell you how many people, Derek, I speak to that say, well, I only need $50,000 a year. And that may be true today. In 20 years, that 50,000 could be dramatically higher. And if your portfolio isn't geared to offset the cost of inflation, you'll find yourself, trying to live off something that really isn't going to hold you.
When you think about inflation too, and we might as well just get into it, right? And gold is one of those things that often people say, look, I'm going to hold gold as a hedge on inflation. It's a hedge against really bad market returns. And it's a hedge if, something geopolitical happens in the world. Thinking about gold in the late 1970s into, I'd say, 80, 81, gold jumped. It had quite a bit of run. Interestingly enough, too, and I think it was 2007 through the financial crisis, and maybe a little bit beyond there, gold had another one of those, runs, even though inflation wasn't necessarily present. But there's a period, Jay, from 2000 until I think it was 2016, 2017, that the real return on gold was something like, and I may be rounding here, about negative 2% annualized real return, meaning after inflation on gold. So gold is one of those things that people a lot of times hold in the portfolio, but it doesn't pay a dividend, and it might sort of be dead money for a lot of years.
I couldn't agree more with you. Gold is, it has been, a vehicle to consider as a hedge or an offset against inflation in the past. Again, the market is a different place today. I think there are better tools at our disposal. Listen, not all things are better in the market today than they were, 20, 30, 40 years ago. But one of the great things is you have more tools for protection. You have better ways to manage a long-term portfolio. And gold just doesn't. There's a reason why the price has hardly moved over the last decade, right? It's not to steal a Zeppelin line, right? But all that glitters is not gold, right, anymore, right? And so I think, sorry, I had to throw it in there talking about gold, but I think it's worth considering that while having some gold is interesting as its own individual asset class, but as a hedge and as a protection vehicle, I think the luster has come off.
No, and I agree. I mean, it's interesting too, Jay. I mean, you and I both delve and deal and live in the options world. And I think you mentioned that portfolio theory and modern portfolio theory and asset allocation, a lot of the ideas go back many, many years. Options in the grand scheme of things are a relative new phenomenon. I mean, really, you and I were in the markets in the 90s, and I mean, not a lot of people used options. And one of the things that I wonder about is, are people using options to hedge more than they're using something with gold, because there's just a little bit more of a defined, outcome that you can build.
Yeah, I mean, it takes a long time to shift the trends of investing and investing process. And while you and I know there's no better way to mathematically manage your risks than with the use of options, you don't have to rely on things like correlation and inverse correlation. And, oh, there was an exception why this didn't work, but the last 8 out of 8 times it did work, but not when you really needed it. Like those things, don't exist when you use options because you're mathematically, managing your portfolio. And without getting into too much detail there, you're right, Derek. It is going to take time for the world to continue to adopt options. However, there is an exponential growth when it comes to the number of option contracts traded year over year. And so it's great that professionals like you and I have embraced options. We think they're great. We think that they should be applied to the individual investor portfolio. It's just that they are a little more complicated. And having somebody help you with them and getting a little education on options, unfortunately, is a barrier that, bonds and stocks, there's a lot less of a barrier. And so it's just easier. But easier should not mean better, especially when it comes to managing risks. So you're right. I think the world is adopting options. We wish more people would do it. I wish everybody would hedge. I wish everybody would use options for protection and managing their risk. It's why you and I have these conversations all the time. And so, Derek, I think it's going to take time, but it's time worth investing because I can't think of, besides, family, that's hard to find anything more important than how you're protecting yourself and your family monetarily.
Yeah, we'll probably get some emails about, from the gold bugs on this. They'll say, wait a second, and it's worked in the past. But I think one of the things you have to look at is sort of your cost of carry and what's your annualized cost to actually hedge a portfolio. In bonds is interesting too, because we think about the 60-40, 40% in bonds, and the 40% could be, let's say, the US aggregate bond index, or it could be an ETF, it could be treasuries or corporates. But, you look at these things, and I did a lot of work just digging into some of the numbers about the nominal returns, the not even after inflation. And one of the things I realized was that over long periods of time, a bond's, average return is right around what its average yield was. And so when I look forward and I say, look, treasuries, the 10-year treasury, I didn't look today, but it's around, 2.3, 2.4, 2.5, right? A 30-year is not much more. And so I think it's pretty realistic to think if yields are here, on a nominal basis, not even accounting for inflation. After inflation, they're next to nothing. But I mean, somebody holding bonds should probably, anticipate getting around what they're yielding. And if that's what they're getting, it's a little bit of a dead space. And I maybe that's a little too strong correlate, statement about it, but I just don't think bonds are going to get what they did in the past, especially given where yields are and given that we're not falling from very high yields.
Yeah, listen, if you could live off 2% growth, great. There's not many people, though, that we talk to that 2% is enough to meet their ongoing needs. And so, we understand the dynamics of each individual investor is different. But if you're only getting the return of what the yield is here, it's I don't know how you grow your portfolio using bonds right these days, right? There's a place for them in certain situations, right? But as a core holding in your portfolio, as a driver of growth, I think you're right. I think it's just they don't provide.
Yeah, and that's the nominal return. I mean, if you get 2% nominal and you have 2% inflation, and who knows what inflation's going to be?
You're
It's
breaking even, right?
Yeah, that's right.
If break even is good for you, great.
Yeah, and really what you have is the characteristics of almost a TIPS bond. Of course, TIPS are Treasury Inflation Protected Securities. They're issued by the U.S. government. And the idea is that they come out, they have usually a lower yield. And if inflation vis-a-vis the CPI, you have an increase, your bond's price will increase. There's some different taxation elements there. But, some people look at TIPS and say, maybe I'll buy a bunch of these. And while it's true, you should keep up with inflation. Really, you're not going to have that much that exceeds inflation and really grows your money. Now, one of the other things that I think, we think about is, okay, so we've got, we can look at bonds, we can look at TIPS, we can look at gold, we can look just plainly at diversification. But Jay, I think one of the things that you and I talk about a lot is diversification. There's systematic market risk and there's individual stock risk. And diversification can certainly diversify away, the CEO walking out in handcuffs and the stock going down. But systematic market risk, one of the things we saw in 2008, we saw it in some of these, these fragility sell-offs that we've sort of had over the last couple of years. We've had these deep drawdowns. Is it really doesn't matter what you have, and I'm using air quotes, right? But when you need diversification the most, markets tend to sell off and everything sells off, Europe and, all the different sectors, right?
Yeah, listen, when stocks are bad, they're bad for everybody, right? It has to be, there's asset classes are linked, right? It's rare. I can't think of a case where it's, dump U.S. stocks and roll wholeheartedly into an international holding, or dump large cap and roll into small cap. It's what happens is, right, they are linked in a way that as you are selling something, you are forced to sell winners along with your losers, right? I mean, as you're doing rotations. And so we have seen this where, when things get nasty, all asset classes get correlated, right? It's why you need, what I mean by that is when one group goes down dramatically, it usually infects all other groups and they go down as well. And so the concept of diversification is great in kind of a normal operating market while things are going up. And if you want to pick a tech sector over, say, financials or utilities, that could provide some alpha, meaning a little outperformance. But when it all goes together. And being diversified across different stock classes isn't going to protect you. And we have seen this time and time again. This isn't just, hyperbole here. This is time and time again, asset classes and qualifications across the stock market will all drop. And so I don't, we maybe some drop a little less than others, but they are very highly correlated when things get dislocated in the markets. Would you agree with that?
Yeah, no, I think so. And I think one of the things that's interesting about asset allocation, Jay, and it made me think from what you're describing is this idea of non-correlation. And, a lot of these portfolios that are diversified rely on historical correlations. And what I mean by that is if you go back and you look, let's say, from 2008 through 2018, and you look at the correlation, let's say, between the S&P 500, which is, of course, if you're using an ETF, that would maybe be the SPY, to something like the 10-year Treasury bond, and you're using total returns. From 08 until 2018, And correlations can run from +1 to -1, meaning +1, they move in lockstep. They completely correlate. They do everything the same. And -1 would be stocks go up 10%, bonds go down 10%, complete opposite. Well, there was a really nice non-correlation of about minus 0.72 S&P to 10-year U.S. Treasury bonds. And that's one of the reasons why a lot of people look at that period and say, look, buying 10-year bonds or 15 or 20-year treasuries really worked. There's a couple things to think about there. I looked at, just pulling some random data here, 62 to 18, and the correlation went, instead of being -72, was 0.08. Still not completely correlated, but part of reducing standard deviation, reducing risk, relies on these non-correlations. And one of the things that I'm wondering about, and I could be wrong, and this is just, we'll talk out loud here, is maybe in the next type of downturn, what if it's some rise in yields? It causes bond prices to depress, which causes the equity market to depress. And so for me, building these 60-40 portfolios based upon historicals, if you get something different, people might be in for a shock.
Yep. And, it's interesting on that study that you did. And while you did see the expected inverse performance, right? Bonds went up as stocks went down from time to time during that time period. On a risk adjusted basis, Derek, was it still worth it? Was it still, hey, this was so much better approach than what you and I are talking about? Because actually we've been hedging that whole time, right? That last decade, '08 through 2018, we have been hedgers. We have been investing. Was it better to have 60-40 or is it better to manage your risk directly?
Yeah. Well, this is the crux of the discussion today, right? And so when we talk about a risk-adjusted return, we're using something like a Sharpe ratio. And the Sharpe ratio has its benefits and its disadvantages, its pros and cons. But you look at a Sharpe ratio, it looks at your return minus what you could have got on a risk-free basis. So if you're looking at a 1-year time frame, maybe you could buy a 1-year treasury and you say, thank you very much. That's from the US government. There's really no risk here. I'll take my return. At the end of the year, I get my money back, right? And then you divide it by your standard deviation. And so it's interesting. If you look at 2008 to 2018, I'll give you a couple numbers here. The Sharpe ratio, and 1 is considered really good, anything more than 1. So higher the better. The Sharpe ratio was right about 0.70. So, not too bad. 62 to 2018, the Sharpe ratio is 0.32. And I did it from 28 until, more recent too. And it was about, it was still pretty low. And one of the things that's really interesting, Jay, is that, everyone talks about risk adjusted returns. Everyone talks about the benefits of 60-40. But the Sharpe ratio wasn't that great. And interestingly enough, and I'll let you address this, just buying the S&P and using a hedged equity strategy has a better risk-adjusted return basis.
Yep, no doubt. Actually, I think in your study, right, when you add bonds to the portfolio or the long term, you actually show very little additional risk-adjusted return. Correct?
Yeah, that's right. 62 to 18, it was 0.326 on just the S&P real return and 0.33 on 60-40. So basically the same.
Basically the same. So adding the bonds over that long period of investing didn't really add additional risk-adjusted benefit, meaning the money wasn't worth investing that way, right? It didn't make that much of a difference. And actually what you did in that scenario was you actually restricted your growth over that time period. Now, you did it in a less volatile way, meaning your portfolio up and downs were a little less, but it wasn't worth it. It really wasn't worth making that change. And so, when we talk about investing, it's really important when it comes to growth. If you're in need of growth, we are planning these days that our clients are going to live to 90 years old, 85, 90 years old. And there's a long period of time of investing that's necessary to make your money last that long. And this is not news to anybody. Everybody knows this already. So what do? Well, you have to invest in markets that are going to meet that need. And for us, investing in the stock market is one of the best ways to capture growth. Unless you're going to start your own company and sell it for $10 million every 5 years, most average Americans need growth in the market to realize their potential and their needs. And so you have to have exposure to the stock market, and limiting that, being too conservative on exposure to the stock market, can be prohibitive. But you also know you can't take the risk of a minus 40% year or 38% year like 2008 saw. And so, you need to take those bad years out of the equation, but capture all the benefits of the upside of the market. And so the long and short of this is, Derek, you know this, I know this. Investing in a way that limits your downside, being hedged, but still captures the upside, is the modern way of investing, and will give you a better risk-adjusted return. Because when you could take out those really bad years, when you could limit your losses to, I don't know, a nominal rate, whether it's 8%, 10%, 15%, wherever your limit is going to be, when you can limit the participation in the downside, but continue to be invested in the upside growth of the stock market, that is the thing that delivers superior risk-adjusted returns.
Yeah. By the way, Jay, I'm just isolating the 10-year Treasury bond. Real return of about 2.2% on a geometric real return, and that's deals with compounding. Its Sharpe was only like 0.11. Not great on its own basis. And by the way, the challenge with using every investment prospectus says past performance does not equal future results. But what does everybody do? I shouldn't say everybody, I'm using air quotes, right? But everyone looks at, hey, we're going to use historical prices to try and price out what's going to happen in the future. And I don't know about you, but I have an issue with using 40 and 50 years worth of Treasury bonds or different types of bonds that were yielding much higher amounts. And I just think going forward, it's really, I don't want to say dangerous, but I wouldn't expect the same types of returns given where yields are going forward. And to your point, Jay, just buying the market, getting the majority of an upside return, missing out on the majority of the downside, has a better risk-adjusted return scenario, and you don't have the drag that bonds. I mean, the drag is really that you've got to pay a little bit for the protection, but you get to invest in the better stuff. I shouldn't say better, but the chance for higher upside, right?
Yes, I think you're being very deliberate and careful about the words that you're picking, and I can appreciate that, Derek. But I think your point is, hey, putting your money, comparing how your money is invested today isn't fair to all the history used of building that model, right? So we were looking back at that data, and it wasn't so long ago that there were double-digit returns on a treasury, right? Inflation was higher, but if you could get double-digit returns on a treasury, like 10% or more, okay, that may be interesting to you, but that's not the reality of today. Today, we've been hovering in this 2%, 2 or 3% range for years, even lower, say 5, 6, 7, 8 years ago. And so, you have to use today's data. And so it's almost like, judging algebra based off of, pre-K math, right? It may not be applicable to the math and the allocations that are being built using those older models. The great thing about options, and I know I'm hammering on this, is they are mathematically linked today, right? You can use an option, and the great thing about an option is it will limit and give you your growth potential and your loss potential today, right? It's not like, well, historically speaking, options have moved XYZ when the market moves ABC. Nope, you don't need that. They mathematically limit what your risk is going to be. And so that's the great thing about the portfolios you're building and we're building at Zega is you can define the outcomes of your portfolio pretty well.
Yeah, no, that's right. And I think also there's a couple benefits to me. A lot of people try and time the market, and we see this again and again. And I always joke around whenever somebody talks and says, "Hey, you shouldn't try and time the market." They trot out the whole if you miss the 5 best or 10 best days in the market, and your return is hurt, and that's not incorrect. That's correct. You got to be in the market. But I think there's always a lot of fear in the market. And, today, Jay, recently, and I just did an episode of explaining the yield curve. I'll link to that. But, the yield curve inverted, and everywhere you look on CNBC, there's a recession that's going to start here. The yield curve's inverted. Here's the average time to recession. By the way, at some point we'll have another recession. Although I guess Australia is the longest running country without one. It's been quite some time.
How long has it been?
I shouldn't have said that without looking it up. But
you did it. You blow it.
I don't think they actually technically had one in 2008. I could be wrong. I'll have to update everybody. But at some point there'll be a recession. But to me, it's, a lot of times the crowd is wrong. And, the rates are so low around the world, and the front end of the curve is what the Fed really controls. And, the Fed funds rate is 2.4%. You'd expect the front end to be there, and demand is on the back end, then you'd expect yields to be lower. But this all sort of plays out to, if you get out of the market, let's say, or if you're afraid to invest and you're afraid because of what you're seeing on TV, to me, it's the opportunity is to use the hedged equity strategy. And, I know we have a little bit remaining time. Jay, we'll have you back on. But this gets into the hedger's opportunity. I'm going to link to an article, Jay, you just published. I thought it was a good article. But to kind of round out things here, not only can you hedge the downside, you can take away some of the timing, but there is that hedger's opportunity.
Yeah. And you just hit on a lot of great points, and the whole reason why we hedge. I will tell you, one of the biggest points you brought up is market timing and emotion. If you could take that out of the mix, your life as an investor becomes a lot less stressful, for sure. But let's touch base on the rest of that in another episode, Derek. But so thank you for having me on today.
Yeah, of course. Well, Jay, thanks for coming on. We'll have you on soon. For everyone else, I'll link to a couple of things we talked about, and we'll probably have Jay back for a episode number 2. Adele, Jay, you're a frequent guest, so we'll have you back sooner than later, though. How's that?
I'm happy to be back. Thank you.
All right. Thanks, everyone. We'll talk to you soon.